Thank you all. It's an honor to be presenting here, and I appreciate every single one of you being here. And I hope this is an engaging discussion. And the single most important thing I want to say at this point is do not strain your eye too much to see any particular graph or slide on the slides. I hopefully will capture the highlight of each slide very directly. I want it to be a very conversational discussion here. So I want to give you the overall context when we talk about oil. I think we went through a very interesting period. The period, I would say, from 2014 to 2015, there was a very aggressive decartelization. I use the phrase, and you could call it free for all, but there was a period where supply started to have a race to the bottom. We saw that change again with a very, very constructive framework, the OPEC-Russia collaborative approach towards controlling supply, which I call ROPEC, and there was a very good response, very good supply discipline, more than even offsetting the shale growth, in our opinion, by what we model. And we set up for a very constructive 2018, right? I mean, we agreed demand looks extremely positive for this year. We are seeing supply declines, for instance, in places like Venezuela, far sharper than we thought. In fact, even more than offsetting the full range of assumptions people have on the delta in terms of shale supply between the bulls and the bears. You have a very constructive setup. You have the restocking potentially after the Chinese New Year of the teapots. From what we track, there are very good signals. The physical premia looks very good in the market. However, no better time than this to talk about disruption. Because when we model out long-term demand from this point on, and we've tried to do a very detailed bottom-up exercise here, we see a period where demand growth would be challenged even with global GDP growth. Not substantially in the sense in terms of immediately plummeting, but the growth rate, we believe, from the early to mid-2020s, and I can literally walk you through how we've constructed a model, poses a challenge. And basically, there are three components. What we have tried to do is model the gasoline demand disruption in a very detailed bottom-up way. Also look at the declining oil intensity of diesel demand because of the level to which we've got industrial efficiencies and scales there, as well as more process efficiencies, more process automation, more lightweighting. And also, a third impact, which this region is obviously familiar with, what you're seeing in terms of North American and elsewhere, NGLs, natural gas, liquids, and natural gas becoming a part of the petrochemical feedstock. So it's coming from all three sides, and I want to talk a bit about what that means and what the region can do about it. So here, this is where we come out, and it's very, very important. We do not think that there is no, many folks, including many of the oil producers as well as OPEC folks like Exxon, do not see a peak for oil demand through 2040. Our model shows a slightly different number. We do see it peaking in the mid-2030s. And more importantly, it's to understand how we've constructed this. What is it? What leads us to this conclusion in a bottom-up fashion? In fact, we have China in particular, if you see the slide there, but you don't need to strain your eyes. China in particular, the gasoline demand growth, we think the growth rate would be challenged from the mid-2020s and more so in the 2030s. So that's a very, very important point. As well as we've tried to literally build up each component, so we are neither with the techno-evangelists who predict a very, very immediate peak. Equally, we don't see a very prolonged rate of growth and not seeing a peak through 2040s. So let me lead you through what gets us to this particular chart that we are showing here. Now, again, we have 4 drivers, and 3 of them lead us to that peak, to peaking in the mid-2030s. The single most important point, I think people have not discussed in as much detail as they should, is where exactly is gasoline demand headed? In its simplest form, it's a combination of just 2 things: vehicle miles traveled and your fleet average fuel efficiency. And every type of disruption you're talking about, whether it's ride sharing, etc., needs to be modeled through your vehicle miles travel module. And the rest of the disruptors, right, whether it's electric vehicle penetration, whether it's improved regulatory impact on internal combustion engines, ICE vehicles, flows through the second fleet average fuel module. And we've tried to build this up literally country by country. Not so much that we can forecast with precision, but rather we should not ignore each component. It gives you a much more detailed look into the level of disruption as you peel through the onion of each layer. So I'm going to walk you through a little bit more about some of the key conclusions we drew by looking at each of these two components. So this is the result. So we have a period where we have about 0.2% CAGR through most of the 2020s in gasoline demand growth, even with a healthy global economic growth assumption. And a lot of this has happened because Chinese gasoline demand has been a bit more challenged in terms of growth rate, but Indian demand is still pretty healthy. And a lot of this flows through our detailed modeling on Chinese electric vehicle penetration assumptions. But the real issue comes after 2030s. Why am I presenting this to you all? Because in the 2030s, when we think you peak, we fall off at a much sharper rate than others are forecasting. This is not one of the passive models. We've tried to be bottom up. And if you ask me, why is that? That looks very awkward. You have a slower growth rate and suddenly falling off a cliff in 2030s. What happens in 2030s? It's a double whammy. If you actually start to model it out, there's two things, right? There's scrappage of existing fleet and then increased EV penetration. So through the 2020s, yeah, EV penetration is starting to grow, but still you have all the existing old vehicles still there contributing to gasoline demand. And this is very important. This is the type of conversation I hope to have with the region. So there is nothing immediate shocking, but yet it gives you a good period to prepare for the future. So the issue is not even that it peaks in the mid-2030s, but post-peak, we think the decline rate of gasoline demand could be stronger than you all expect because EV penetration will kick in just as you're in peak scrappage. I think that's a discussion we hope to have. Now, how confident are we of this? So we did some very detailed crossover analysis, and I've discussed with many of you in the region even last year. So when I was here last year, we said how the vehicle cost comparison shows that by 2026, if you looked at the powertrain, your conventional internal combustion engine and the entire powertrain, and you looked at the battery and the inverter and the motor costs on the EV side, they crossed over even without the additional subsidy benefit. And even without NPVing any fuel savings, they started to cross over in 2026. And I was asked, how do you know your assumption is right? Where can it go wrong? So the question was, okay, let's look at the battery cost components. So we said that we are looking at a migration of the battery pack, which goes from NMC 111. I'll keep it very simple. Roughly equal quantities, you can think about it, of nickel, manganese, cobalt being very expensive, to an NMC 811 technology. You get higher energy intensity, and you also get a lower cost, more on nickel and less dependent on very sensitive or scarce metals like cobalt. But the very, very important point here is the dotted purple line, which is telling me that even compared to what I presented to you all with some of you individually in the meeting in the region to last year, the assumptions have come in even better. In fact, the disruption is likely going to happen faster in terms of battery cost than many of us imagined. And that's a very important point to think about. Then we go through each of the country-specific models, and I'll explain this in a little bit of detail again. So we have the Chinese, as you can see, by 2040, we have roughly 35-40% of the fleet being EVs in China. But more importantly, the very near-term growth, I think by 2021, 2022, we think if we get to about 2%, then we know that we are on the right track in terms of our assumptions. It's something we are going to constantly validate or model and check to see if we are indeed modeling this out right. And in terms of the waves of adoption, it's very similar. Everyone gets skeptical about new technology for two reasons. Early adopters, typically, there's lower performance, right? There's lower miles, lower distance, but lower cost. Then you migrate to the very high end, right, which is, you can see here the Tesla Model S, etc. You go to the very high end, which is very good in performance, but fairly expensive. And then you come back to the economic majority, where you preserve the performance of the high end, but yet make it more affordable. And I think wave 3, right, in terms of technology adoption waves, is the one that's most important and one needs to have their eyes on, because whether a disruption succeeds or fails depends on the wave 3, as we call it. Now, very quickly, when we meet with our own investors and others in the US and elsewhere, you get a question: how comfortable can we be about China policy? Will the subsidies sustain? What if they do something that makes EVs less attractive? This is a real concern, but we have to monitor it literally every month, every day, as news items come on. And what we saw, even with the EV announcement that you saw last week out of China, it was thoughtful. Yes, subsidies were cut, but only for the non-performing side. For more than 400 kilometers range, the subsidies actually went up 14%. That's the inflection. The bottom middle slide is talking about that. So from a policy incentive as well, we think it's actually very well tailored to the phase 3. So we think that we are fairly comfortable with our EV assumptions. And if at all, we might even need to, we have to see the data points, but we might be revising it even higher in terms of the rate of penetration. Now, one thing, again, and this is something I'm going to give the good news, the techno-evangelists always are showing everything as disruptive. But there are disruptions that actually help increase oil demand. Ride sharing, if you actually model it, there are so many deadhead miles people drive between pickups, whether it's Uber or otherwise. An analysis we have done shows that in major cities, bus transport reduces, some of the other public transport reduces, and ride sharing actually increases VMT. And that's a very interesting thing. It is a disruptor, but it's a positive disruptor to the region, and one you all will be very aware of because you've also invested in this as a region, and Abu Dhabi in particular is invested in the leaders in this segment. So it is a component we have captured. We have not ignored it. This actually helps demand a little bit on the margin, and it's really EVs the one that's putting pressure on the gasoline demand. Now then, this is where we are. Gasoline demand, I've mentioned this already. So we think the peak gasoline demand hits about 2031. And again, it's not so much about a slower growth rate for the next decade. It's actually a positive for this region, but it gives you a chance to prepare for the period from the 30s to the 40s, where we think gasoline demand can start to fall substantially. Now, the investment universe, if you look about electric vehicles, this is also extremely important, right? When I get asked, is there enough cobalt in the world? Are you sure you can do this? Is there ability to even produce that much cathode material? We've done very detailed bottom-up work, and this is the single most important point I'll say. Whether you agree with me on the data point, whether it's 2% or 1.8% or 3.2%, the main point is to work backwards, peel the onion, do a bottom-up analysis, and see the impact across the supply chain, right? What is the impact on cells? What is the impact on chemicals? What is the mining impact? What is the lightweighting impact? And for a region that has invested in many of the disruptors, I think this is an exercise worth doing and literally worth a refresh almost every single going day. I think the single most important point here is to do the bottom-up analysis. It's painful, I can tell you, but it's worth doing it because it completely, when you start to peel the onion layer by layer, you can see what is going to be this impact. And far beyond what I have in this slide, will we be prepared in terms of charging? What's the impact on power demand? How are the diurnal shape of the power demand change? And it's an ongoing analysis many in the world are doing. And I think there's huge implications for the investment potential it creates. And that's a very important point I want to take home. I've barely scratched the surface in terms of the investment universe that's affected by this EV penetration. Another very, very important and underappreciated disruptor, diesel demand. It's steady, it's slow. But look at it, I would say, literally since the end of World War II, the per unit GDP growth, diesel demand, has been coming down. And you can talk about on-road and off-road, there are differences. But effectively, we are becoming less energy intensive per unit growth. We are making smaller vehicles, right? We are lightweighting better, we are using more aluminum, we don't carry unnecessary inventory. Our process automation has increased, our process efficiency is increased. So the number of material or stuff we use per unit GDP is continuously coming down. I can't point to any one disruptor, but we've done the analysis, and actually it's a credit to the region. When you look at where all the disruption is coming, right? Reduction of manufacturing cycle time, reduction of lead time, machine vision, the extent to which assembly lines are getting more efficient. Many of the investments of your region actually goes into chips and really goes into the nuts and bolts of industrial automation, vision systems, etc. It is very real. And vision system CapEx actually has one of the highest net backs. This is, again, an area where this region has invested in, and this disruption is also real. I think the per unit GDP growth, the amount of diesel demand slowly starts to decline. You have multiple disruptors all working to different degree. Again, the important message here is how do you benefit from that, and how do, as a region, you want to be the right way risk, right, as we call it. Same with chemical industry, right? You cannot ignore that natural gas liquids has become a significant part, especially at the light end, right? In terms of polypropylene, polyethylene feedstock, this does have an impact on naphtha demand, right? From the petchem component of demand. Again, this is something you're all very, very aware in this region. You're invested in North American chemicals. I'm sure you look at it every day. But this is the third factor, and that's a very important point I want to make, right? Yes, there are too many moving parts, but that's actually a great thing when you try to model it. When there are too many moving parts, it forces you to analyze each component of demand, and then for a region that can actually invest in this, you can see how you are the right way risk, how you're benefiting from it, and even in terms of quantum, it tells you the relative impact on oil, and it helps you sort of plan into the future. So I would recommend to be involved in this type of analysis on a very regular basis and help quantify this. Again, total oil demand, this is the mid-2030s we peak. And the point is the real gasoline and diesel both have issues. Petchem is still strong, but gasoline kind of stalled demand growth, not falling through the 2020s, but stalled, and it's post-2030 that the real issue comes from gasoline. Diesel has been very steady. I think diesel, sort of per unit GDP growth, you're seeing that reduced intensity play out quite regularly. Now, conclusion slide, important, but please don't look at the slide. I'm genuinely talking to the region one-on-one, right? So my take here is, look, you've got a very good setup. OPEC compliance has been very good. Global demand growth has been strong. Chinese post-deport refinery demand, we believe, is coming up. Physical differentials are strong. Very good 2018 position. However, and you do have a period, I think, if you follow closely the policy announcements on EVs, trends there, follow the same thing in terms of industrial efficiencies impact on diesel, you do have demand growth being challenged over the next decade and a half. I'm not trying to predict how supply will respond, and we'll assume that between OPEC and shale, that there will be sort of a balancing act in terms of the supply response. But you here have the benefit of being in a very, very strong position, right? Your sovereign wealth fund is what, like 3 times GDP. You already invested in portions of this disruption chain, right? You are invested in everything from ride sharing to aluminum to chemicals that use North American feedstock. So you are and to chips that literally are the brains behind industrial automation. But the point I want to make here is this is a continuing trend, and this is much stronger than you might have imagined. And to go through this bottom-up analysis, I'd love to actually, if I had the time, have this discussion in detail with every single one of you in terms of sort of bottom-up what's happening, and then work through the entire supply chain of global industry and technology and see what the impact might be. The second point, even more important, and it's going to be the future panels, if you just think about it, if you ask me a question, and I was just doing it last night, back of the envelope, back from the Louvre. If you told me that if today you waved a magic wand and every single vehicle was an electric vehicle in this, in the whole world, what would power demand increase by? It comes to 13 to 15% of the total power demand. So the point is, you're switching some of the demand for gasoline to power demand, and renewables will be a key part of filling that power demand as well, going to the next panel. And I think it's a very important point because power demand has been stalled for a long time, right, globally aggregate. But I think this EV shift does switch to power, and also the diurnal pattern changes, right? So it's not as available power becomes actually quite effective, right? It's not the usual, you're super peaking at 2 p.m. load. You get your diurnal pattern that's much more stable, which is extremely positive for renewables. I'll let the next session speaker speak to that. And also the session after that, some countries do have a good tailwind for structurally lower oil prices like India. I presume the panel after that will discuss to this. But really, the essence of this, the single most important thing here, message, one sentence, if you let me, is you have to peel, whether you agree with the point estimate of oil or not, is not as important as trying to do a bottom-up analysis and peel each layer of the disruption and to see how the region's real economy can also benefit from participating in it. The point is to thrive under any oil price scenario. And with that, I'll take questions if time permits. And
So if we have any questions for Dr. Sriram, please raise your hand. Sorry, we'll come to you. Just one question over here. We'll come to you, sir.
Good morning. Next year, United States is expected that the production of oil, gas will surpass Russia. What will that do to the price of oil? Thank you.
Oil. Exactly. We think next year will be relatively range-bound. I don't want to make a specific forecast. So let me just take one scenario. As long as, a broad belief is as long as the OPEC exit is gradual in 2019 or the deal is extended into 2019, it could, I think it could be relatively moderate. But still, we think this summer is likely the peak, the strongest period. But there could be slight downward pressure, we believe, since starting with 2019, but it can be managed, right? It can be managed by supply. And I'll give you the numbers too, right? Rather than being sort of just talking about things loosely. So this year, right? So 2018 versus 2017. I had about 1.6 million barrels per day incremental supply, 1.3 coming from black oil and 0.3 from NGLs. So about 1.6 year-on-year growth. Next year, it'll be hard for US to have anywhere close to that number from what we are monitoring as recently, right? We monitored, most of the announcements coming from the US earnings season recently. There are still some infrastructure issues to be resolved in the Permian Basin. So we think, yes, shale supply will continue to grow, but the rate one has to watch depending on the infrastructure constraints, especially around the Permian Basin. And of course, the very important point for 2019, your point, just sort of, you're coming out of, or maybe not out of, you're potentially coming out of the OPEC deal in 2019. Do they extend it? Do they gradually, let supply come back from the level of cuts? It'll depend on that.
Okay. Thank you. We have one over here, microphone number 6, please.
Thank you. Very well presented. I have just one question. In year 2017, the price increase which has taken place, is it just because of the compliance by OPEC and non-OPEC, or there are any other reasons?
There's a lot of positive reasons too. So 2017 was very interesting. So let's list one by one. Compliance was a key factor, OPEC and non-OPEC. But let's face the fact. Supply declines, personally, from my own modeling experience of Venezuela and certain other countries, have been steeper than we thought. Demand has also been slightly stronger than we thought, especially Q4 17, I would say, was definitely stronger than we thought. And some of the interruptions in Q3 also helped, right? You had a large number of refinery restarts. That's also worked. So demand has also been healthy. Supply discipline has been there. And I think market always, look, there's always an expectation. So I'd say relative to expectation, US supply growth, I think, has been high, but not so high, right? In late 2017, you saw that the supply growth was I'll use the word as expected, at a time when other declines were stronger than expected, and demand was slightly stronger than expected as well. So confluence of factors.
Thank you. Okay, any further questions? Over there, please, microphone number 4.
Hello, good morning. Yes, last year, China extracted for the first time what they call the frozen gas, methane hydrates. Apparently, with 1 cubic meter of this fuel, you can recover 164 cubic meter of natural gas. Do you think that this new kind of fuel could be viable in the future What are your thoughts about it?
Look, it's very early. I haven't looked at this particular one. I haven't looked at it in as much detail. But again, we need to continually monitor, right? This is something I can't just answer it at this time. And in fact, that's the right answer to give, because these disruptors you have to watch closely. I'll tell you honestly, but and then Shaman and I had discussed this even last year, right? So we had certain estimates for EV demand, we had certain estimates for battery cost reduction, etc. But they have panned out stronger than we thought this year, right? So let's not be dismissive. Our views ourselves adapt. My take on speed of EV adoption has changed, and it's come out stronger. Same with my take on renewable, right? Having been in the power industry long time, right? We always tend to say, oh, as available power is not like baseload power. But when you see the diurnal patterns change, and when I start to project post-EV, the charging patterns that could happen, we have to be adaptive. Let's watch it. Look, I don't have a view on that in particular, but we'll watch it and monitor it. Let's see it.
Okay. Any further questions? One on the front row here, please. Just on the front row. Thank you. Microphone number 3, please.
Great presentation. Thank you very much. As technology improves globally and as we approach singularity, hopefully, do you really think with the disruptive technologies, whether it's autonomous transportation, electrical cars, etc., oil is going to be like coal and slowly become a very cheap and not wanted source of energy, and other sources of energy are going to really be the main sources of energy?
Look, I have to answer this carefully, and timescale. Timescale is very important, right? Oil, so I'll break it up into 3 phases. Let's face it, phase 1, phase 2, phase 3, right? Near term, it's tight, we agree it's positive. So 2020s will be a period of stalling demand growth, right? So demand growth is still positive, so you're not yet at coal effect, right? Just demand growth is positive, but not at a high slope, right? So you will have that period from 20 to 2030s where stalled demand growth, even when you have high GDP growth, slower rate of growth, 10 years. But once you get to the 2040s, looking at my decline rate, rather than try to make such comparisons, but in 2040s, late 30s and 40s, yes. By 2040s, I think oil demand is going to be seriously challenged. And I think that's, I'm not using any sensational analogies or otherwise, but you do face a negative growth rate in oil demand after 2040s. I know it's not OPEC's and Exxon's and Statoil's numbers are a bit different, and we have to monitor. But sitting here today, I do think the one factor people need to do, and why one needs to do a bottom-up analysis, you made a great point. There are 2 things. Just don't focus on the new rate of change of new technology, but also on the scrappage of old technology. So as we sit here today, that's why we are saying it's going to happen. Since 30s, it starts falling, and it accelerates even more in 40s, because we have scrappage of the existing fleet hit around the same time as the EV penetration takes off. So it's a detailed exercise, and I'm sure, if I went over with each one of you with the model in detail, there might be one or another parameter I might tweak, but that's sort of where we come out. So I think the phase 3, yes, looks better. Phase 1, stalled growth. Phase 2, small negative growth in 30s, and 2040s and beyond, yes, it does. It does look challenged.
Okay, thank you. So unfortunately, we are out of time, but Dr. Sriram is going to be with us. So if any of you would like to continue the discussion on oil and his views on EV, etc., please, he will be around, so please do feel free to connect with him. Dr. Sriram, thank you very much.
Thank you so much. Thank you so much. Thank you all. Thank you so much.
Thank you.